Here at Unrivaled Investing, I often dance to my own beat. So when I recently heard that there were near record outflows in the US healthcare sector and that healthcare stocks in general reached a low valuation relative to the S&P 500, it definitely got my interest. And you could see how healthcare ETF, the stocks underlying, have definitely underperformed this past year. The market's making new highs, and yet XLV, the healthcare ETF, is down about 8% in the last 12 months. One of the stocks leading this worsening performance is Centene, CNC. The stock has lost over 55% of its value so far just in 2025, causing investors to wonder what is going on with this company. When I turn to Flash, my AI assistant, it's completely free to use. You can check out a report on any company in the world. So once again, check out that link below. It actually says Centene has pretty good quality for business, 9 out of 10 for business quality, 9 out of 10 for market position, 7 out of 10 for financial position. And it says the prospects for the business are actually quite interesting for shareholders right here, saying on a base case that there's well over 100% upside. So this does get my interest where I want to learn more. And yet I see the stock, I see management previously had guidance expecting adjusted diluted earnings per share of over $7. And this is a stock that currently, after getting thoroughly walloped, is now trading around 27. Now, keep in mind, that was their previous guidance, $7 versus the $27 share price. But it does make you wonder, wait a second, if management isn't completely crazy and that $7 is something they could possibly do in the future, let's say 5 years from now, 10 years from now, 3 years from now, then that would be remarkably cheap. $27 stock, $7 potential earnings, you're talking about around 4 times earnings. Most businesses at 4 times earnings, they either gobble up, let's say 25% of their market share each year, which is clearly doesn't last in the marketplace because it creates a 25% annual return for shareholders that sit tight, if assuming the valuation stays the same. Or you get massive valuation expansion, goes from, let's say, 4 times to 15 times, so a multi-bagger. Or you get an acquirer that says, hey, I'm just going to buy this up because it's so cheap. So you can have a confluence of events that might happen when you get to these types of deep value sort of situations where management said, hey, we previously thought we could do 7. Something's happened since then, and we're going to talk about that in a second. So that was their previous guidance. That's important to recognize. But could they get there again in the future? That is really the question I think investors need to think about because the market is saying we are doubtful. Now, when we look at Centene, you could see, look, this is a business. This is the #1 carrier nationally in the ACA or Affordable Care Act marketplaces. You're talking about insurance coverage. So this healthcare coverage for 1 in 15 Americans with roughly 29 million members. And you could see the different membership, exposure, whether or not it's through Medicaid, which is around 13 million. That's been declining a bit. You could see their marketplace growing a bit. You could see Medicare as well and Medicare prescription drug plans. So overall, around 28 million. Looking at their revenue, premium and service revenues, you could see the vast majority of it, $21 billion from Medicaid, around $10 billion from Medicare. So that is the key driver of this business. Those two are the big components when you look at, really it's Medicaid and Medicare. That's the biggest components when we're thinking about Centene. Now, further digging into the company, once again, this is from the free report from Flash, talking about that 9 out of 10 market position. So it's this leading market position where it has the largest Medicaid managed care organization in the US, serving top 2 or 3. So it's in the number 2 or 3 position in nearly every state it serves. And once again, the #1 carrier in the Affordable Care Act exchanges. And this is across 29 different states. And, it is important to call out that when you do have a top position like this, it does make it easier for you to negotiate with the various different providers, the doctors, the hospitals, and network to try to get better costs. So that is an important data point to consider, is when you are the #1 player in the different states, in the local markets, you should be able to get better pricing. And yet here it is, CNC stock has gotten crushed, 55% drop so far year to date. Now, why is it? There's several reasons why, and we're going to sort of talk high level about some of the key things, but they're really the decline accelerated significantly in just the last few weeks. The first piece that really caused a dramatic drop was due to their pulling guidance, where they said, hey, we're completely withdrawing our 2025 earnings expectations in July, which was due to two factors. They're saying, hey, we got to scrap that previous $7 earnings, partly because the overall market growth in 22 states that they were looking at was lower than they expected. Now, maybe that's because of individual states. You're having this sort of transition. You had a COVID-focused economy where many different states said, hey, we need to beef up the benefits for those, that need the financial care or the elderly. And so maybe you're going a post-COVID economy where you start pulling some of those enhanced incentives on a state-by-state marketplace in Medicaid and Medicare. So you're seeing that dynamic. So maybe that is part of the reason why the overall membership growth is lower than expected. But the bigger reason, and this is not just tied to Centene, is that they're seeing significantly higher than expected, effectively healthcare costs, medical loss ratios, health benefit ratios. This is not just Centene, as I already mentioned. This is United Health, Elevance, Centene, Oscar. They've all working similarly with I believe it's Wakely is the independent actuarial firm, calling out, costs have been jumping higher. They're not sure if it's a less healthy population. Maybe that's due to the states, pulling some of the incentives. And so you're getting maybe some of the sicker folks coming into different, let's say exchanges. Maybe it's just, you're seeing an uptick in hospital usage or emergency care usage. You have seen that, different, I think Elevance called out that they saw an uptick in emergency room visits. You also might be seeing an uptick in otherwise healthy cohorts of the population saying, maybe, I'm a little overweight and, I hear about these miracle GLP-1 drugs, and in the past I wouldn't have gotten this prescription, but you know what? I want to lose that 30 pounds, and they go on it. What would have otherwise been a healthier patient population then goes on a new drug. And personally, I can attest to that type of dynamic. I previously struggled with headaches all my life. I had gone on a lot of different diets. And truth is, I can't eat bananas, onions, or avocados because otherwise I'll get like a killer headache the next day. And even with those dietary restrictions, I was still getting headaches like 2 or 3 times a week. And yet just in the last few months, I tried Emgality, which is a relatively new drug. I'm not recommending this. I have zero recommendations or anything like that. But my headaches have dropped to like once a month. It's truly been a game changer for me. And I think this is an example of we might be in an age where there's more and more new drugs that are coming to market. And that is a net positive for individuals, but maybe for insurance companies, it's a net squeeze on margins, possibly for the next few years. That is a real risk I think investors need to think about. So that is something to consider, is at least for this window where everything's under patent protection, where the creators of various different types of drugs, they are going to have that outsized margin so that they can reinvest. And, until everything goes to generics and everything's arguably much cheaper. So you could have a period of elevated inflation where you see the costs tick higher, partly because maybe we are in some sort of golden age of invention, creativity, bringing new products to market. Another example, this is a little bit of a tangent, but I'm sharing personal stories that reflect, I do believe we are sort of entering this golden age. My mother, hi Mom, I'm sure you're watching this. My mother had an eye procedure this past year, and she would have been blind without it. And the doctor said pretty much this eye procedure has only been around for the last 10, 15 years. So otherwise she would be blind, and otherwise now she's able to live her life, have a good time playing mahjong with her friends on a nearly daily basis. So you see enough examples like that and you go, wow, there really is acceleration. There really are going to be new products coming to market. My personal story with headaches, my mom's story with her eyes. So the optimism for society might have a cost from a health insurance perspective. So you might be seeing that here as you look at Centene. pulling, their guidance. And they previously were talking about this $7 in earnings just a few months ago. Just in May, they were reiterating this message to investors. They had been talking about it for a while. This was actually in 2024 at their investor day. They talked about 725 in earnings, adjusted earnings. And a key driver of this is, once again, this health benefit ratio or medical loss ratio. Every dollar in premiums, there's effectively their fixed costs, their sales, general, and admin. That can range depending on the company from maybe 10% to 15% or sub 10%. So here it is. They're well disciplined. They only have around 8-9%. But then the rest of the premiums they collect go to these medical expenses. And they were budgeting around 89%, for their business in 2025. And yet the big problem is that it's been surging higher. And during the second quarter, they reported an unexpected loss. This further caused shares to drop because this health benefit ratio went from this 88% last year to 93% this year. And you can't have a business model where, let's say, you're running your fixed costs at 9%, your medical costs, you're expecting them to be, let's say, mid to high 80s. If that jumps to 90%, and you're already at, let's say, 10% on a fixed cost basis, you're not making money. And that's been the challenge. So not only did they have to pull guidance, but then it fed into, whoa, your earnings for second quarter really stunk. And so you have these two double whammy, and that's why the stock has lost so much value. So what are my thoughts from here as I think about Centene? First of all, this is not financial advice. I'm just sharing my personal thoughts on Centene. I do not own a stake in it. And also this past week, Sam L., an Unrivaled Investing subscriber, wrote, really get a lot of value from what you share and the way you share it. This follows Brandon M., who said, thank you so much for calling this out to me a few months ago. Unrivaled Investing, I'm up $72,000 and just cashed out my original investment today. So it's all gravy from here. He was talking about a particular company. So if you're looking for compelling ideas, come check out Unrivaled Investing. And when I look at Centene, it has some of the things that I really like to see. Just at the end of last year, management was buying their stock, and it was pretty broad-based across the board of directors, CFO, CEO, buying millions of dollars of stock. So I do like to see that. That said, the CEO and CFO don't own a ton of stock. So I'm not quite sure I would say they're fully aligned to the point that gets me excited. Frankly, just earlier today, I called out to my subscribers at Unrivaled Investing that I was buying a little bit more of a healthcare company that was growing around 30%, where the CEO owns indirectly around 40% of the company. And that's the type of alignment where if there's a problem, he is very aware, hey, I need to unlock this, or this is how I'm going to do it to unlock value for shareholders. And if you own 40%, you're heavily incentivized, and he will be feeling the pain arguably much more than I will. So that is a dynamic, I think about, when I'm adding positions. So here, there's not enough ownership percentage that really gets me excited about Centene stock. And frankly, I've also called out another company, and I called this out on YouTube, and I've done much more detailed follow-ups for my subscribers, but I have called out that the health insurer company that I do own is Oscar, OSCR, and I did a previous YouTube video more detailed for my subscribers. But thinking about the valuation, going back to that valuation, this is once again from the Flash report. So AI clearly sees, it's not just me, I'm not just crazy talk here. AI is saying, look, at the recent price of 28, now it's even lower, it's a very low valuation relative to its own history and relative to peers. And it's just around 4 times what it was doing last year in earnings. And the real question is, you have this guidance pullback. Can they get back to some sort of normalized margins? And so you're looking at this business, and management has made it clear, we are going to have to revisit our pricing for 2026. We're going to have to raise prices. So you have this uptick in expenses. Can they raise pricing plans enough to offset the challenges that they face? And they face very real challenges. Not only do you have the cost inflation, you have the uncertainty in the key markets that they operate, like the affordable care market, where President Trump's spending and tax bill actually cuts the enhanced subsidies that the Affordable Care Plans previously received. So that's going to create more headwinds, more, members leaving the marketplace. You're going to effectively look at possibly lower revenue. Those are going to be real challenges there. So that is important to think about. This is a multifaceted problem. You have changing legislation, you have higher inflation than expectations, and who knows how long this inflation can go on. So there is real uncertainty with this. The question that investors have is, do health insurers have a right to get some sort of margin by providing health insurance to the general populace, or to the sick populace, or to the poor populace with Medicaid versus Medicare? Do they have a right to earn some sort of percentage margin over time? And couldn't they squeeze out a couple of percent? Because if they can, then you're arguably talking about a company that trades at a either extremely cheap valuation to just a cheap valuation. That's one thought process. Another thought process is that it wasn't that long ago that management was saying, look, Medicaid, Medicare, these are growing markets. You're talking about single digits to high single digits. The marketplace, talking about ACA and ICRA, that's also going to be a growth lever. Talking about margin expansion, also a lever. Talking about smart capital allocation between share buybacks and debt management. Management was previously targeting 12 to 15% annual growth as a long-term target. So when you have this situation where you go from $7 in prospective earnings to, we got to scrap the whole thing because how dramatically costs jumped, is it possible that just becomes a runaway train in terms of costs? Or is it possible that it's something that could be managed where each year the insurers go, okay, well, if prices are trending at this degree, we're going to have to raise prices. And we're going to be able to squeeze out 3%, 5%, 7% type of margin for us over time. Can they effectively each year do this correct dance? Okay, well, the trend now is here. Can we price over there? Or you might have the challenge of the government needs to cut its expenses. Is Medicaid, Medicare actually going to go from a growth market to a secular declining market? That's another challenge that something like Centene faces. Personally, as I already expressed, I don't own a stake. I do find it quite interesting. I think the whole healthcare space in general is in this cloud right now because of this uncertainty, because of legislative changes. But I do look at it and I am buying and find, quite interesting several healthcare companies because this general fear, dark cloud of, margins, where will they shape up in the next year or two? But if you believe maybe they could get back to profitability in the coming years, you could have a reset. I personally prefer to align myself with management teams that have either proven it before or they have huge, skin in the game where they've bought millions of dollars of stock or they own 40% of the company. So that's my personal, approach. Every investor is different. I've called out my checklist regularly and the first item is aligned management. So that's just how I prefer to invest. But every investor needs to figure out what's right for them. Would not surprise me if Centene does well in the years ahead, just because it's been so hated recently and a 55% drop year to date. I even called out United Health previously and said, look, there's been significant insider buying. It's plummeted, similar problems. I also said, would not surprise me if that outperforms as well. So we'll see. Maybe it's just a value trap. Traditionally, I view value traps as companies that appear very cheap, but are in a secular declining space. I'm not sure, and I don't think that is the case with many of these healthcare companies, where I expect them to be either caring for more people in the future or just facing, having more profitability and more revenue in the future. I hope this video talking about Centene, this educational investment video, has been helpful for you. If so, please hit that thumbs up, hit that subscribe button. Thanks so much for watching Unrivaled Investing.